Alrighty guys, so in today's video we're going to be discussing what ICT meant when he talked about time versus price. Let's get straight into it. So we're looking at the chart here and I want you guys to focus your attention on a few things. Number one, when we talk about time, we're going to be talking about key trading sessions and macros. So we're going to be talking about silver bullet sessions. We're also going to be talking about macros. When we talk about price, we're looking for price signatures or things that the price does that allow us to kind of have that opinion that price is going to do something important. So it's really important to merge the two together. So ICT mentions time and price. A lot of these people mention time and price, but what does it actually mean? And then how do you use this to execute trades? Let's get into it. So firstly, I'm going to mark out a macro. Again, 10 minutes before and 10 minutes after every single hour, there's a macro. There's not just macros during Silver Bullet. There's not just macros during the AM session, the PM session, the London session. There's macros outside of these sessions that exist and where price could develop in an important way. Now, even though these macros exist, it doesn't mean that all these macros will do something that you want them to do, but you've got to watch that macro progress and develop and see based on time and based on price if there's going to be something important developing in that zone. So what I'm going to do, I'm going to mark out this macro, and this is from 1250 to 110. Now, for a lot of people, this is before London Open session. London Open session is obviously 2 o'clock to 5 o'clock in the morning, but we're going to merge time with a macro and price to phrase an extremely high probability trade right here. And then we're also going to do the same thing to phrase a high probability trade during this macro and also during the London Open session. So let's get into this first idea. So this line here represents 1250. I'm going to mark that out on the chart. That there is 1250 AM. This line represents 110 AM. Now, for a lot of people, you're looking at this and there's not too much going on, but what you've got to do, you've got to zoom out on the chart. So as soon as you see price like this, what do you see? What do you see? Now we're on a 1 minute time frame here. I'm going to go to a slightly higher time frame, being the 15 minute. Do you see any imbalances? Any imbalances on the 15 minute time frame? There's two. One imbalance rests up here. There's another imbalance that also rests here. It's a really small one. And there's a big one that rests below. So firstly, we're using price, and then we're going to use time to phrase the trade. So right now, what has price done? I'm looking at price. It's come down. It's dug back into this 15-minute bullish fair value gap. And I want you guys to have a look at these bodies of these candles. The wicks do the damage, but the bodies tell the story. So I call this a volume raid. It's still the same as a normal raid, but essentially you raid the actual volume bodies rather than taking out the wick. Because as ICT says, the wicks do the damage, the bodies tell the story. So at this point, we've taken out liquidity. I will still class that as a raid of liquidity. This long wick can be classed as a rejection block. Secondly, if we zoom in quite small here in the small time frame, can everyone see that this is a big 15-minute fair value gap we're delivering from, but we're also delivering from this fair value gap here. So in terms of formulating some type of bias or some type of opinion about the market, for me here, we've just swept sell-side liquidity. There's a good chance we could reverse. Where could we reverse to? Well, we could reverse to buy-side liquidity. Where's buy-side rest? Buy-side rests above this swing high. Buy-side also rests above this swing high and any other swing high that rests above. Where else might the market target? Liquidity or imbalances. So if the market were to run up past this high, it would make sense because there's also an imbalance above this swing high. So at this point in time, there's really only two options. There's only two options. Price will either respect the 15-minute busy or it's going to disrespect it. That's it. So at this point, there's two biases. There's two biases, and you've got to determine based on price action which idea you want to take on board and which idea you want to project. Now for me, because we just swept this volume body and because we're delivering from this imbalance, I want to target buy side. What's another reason that personally I want to target buy side? 1 swing high, 2 swing highs, 3 swing highs, 4 swing highs, 5 swing highs. There's a lot of buy side liquidity resting above. There's a lot of buy side liquidity resting above. So because of those two reasons, I'm looking to target longs. That's how I've formulated my idea. Some people call that bias. I call it an idea or a narrative for the market. This here is a 15-minute bullish fair value gap. And this is the exact analysis that I did yesterday. I posted this trade on the community tab. It's all there for you guys to see. Now, this is only one element of price. So far in terms of price, we've looked at the 15-minute time frame, and using that 15-minute time frame, using liquidity, using imbalances, using what's already happened, now we've determined we're looking for a long position. The last step is you have to wait on a smaller time frame to see the price signatures that actually develop to show us that this is an opportunity to take. If the price signatures don't develop, we don't take the trade. Just because I want to go long doesn't mean I'm going to stick to that bias and marry that bias completely, because what if that bias is wrong and I get stopped out? But I don't have to get stopped out if I wait for price to show its hand. Really important. So let's go back to the 1 minute time frame. Again, this is that 15-minute busy, higher time frame PD rate. We've just swept liquidity here as well, volume body rates. We've had a market structure shift, really important. And now I'm looking for price to take a move to the upside. Now I'm going to market all these things on the 1 minute time frame too. All these swing highs are really important. Why are these swing highs important? Why would I like to target these swing highs? This is what I call trendline liquidity. It's essentially where you have liquidity where people could draw a trend line and they'd be taking short positions. When price taps. In other words, I know there's stop losses resting above these swing highs. In other words, there's money resting there. There's liquidity resting at each of these highs. So when people talk about liquidity, when I talk about it, I'm talking about swing highs and swing lows. The market either targets liquidity or it targets an imbalance. And this imbalance is a 15-minute sell side imbalance, buy side inefficiency. So a 15-minute or bearish fair value gap. So right now we're at this point. We're looking for a long opportunity. Now let's see what the macro is going to do to enhance the time factor, because price is there. We've got our targets. We've got the price signatures. But is time in our favor? Well, great. We've got a macro here from 1250 to 110. Now I want you guys to notice this. Have a look at this. If you zoom in on price action, notice this 1 minute bearish fair value gap. Have a look at this. Notice that 1 minute bearish fair value gap. I'm also going to go on the 2 minute time frame so you guys can see what it looks like. On the 2 minute time frame, notice there's a bearish fair value gap and a volume imbalance. So for this trade, I used the 2 minute time frame. I extended that across. I drew this as an orange box, anticipating that if we inverse this fair value gap around the macro period, I will take a long position. If we didn't do that, there's no trade to take. That's really important to keep in mind. If we don't give the price signatures during a key time frame that I want to see, there's no trade that I'm taking, and I'm waiting to the next opportunity or the next macro or silver bullet, because it's quite early here in the market, right? So I see this with price action. Let me play out price to show you what happens in price. We dig into, look at this, we dig into that 15-minute busy we talked about. We inverse that zone. We dig back into that inversion, and my long position came from here. Now, we're at the start. We've still got a lot to talk about in terms of where am I targeting, where's my stop loss going to go. Let's start with a stop loss. I put my stop loss in a position, really important for your notes. Put your stop loss in a position where if this gets violated, your trade ID is invalidated. Really important. So a lot of people don't take you through the process of how to manage this, and today I'm going to take you through it, right? Put your stop loss in a position where if the trade, or if it gets violated, your trade ID is invalidated. Would I want price to close below this 15-minute bullish fair value gap? No. Why? Because we've just used that to push price up to invert this fair value gap. So where is my stop loss going to go? It's going to go below this 15-minute fair value gap. Simple, right? Why? Because if this gets violated, then my trade ID is invalidated. I move on. I take the loss. Happy days. It's not a problem. Now, the next step that we've got to think about is, okay, where do I want to target and why do I want to target those particular zones? So we've done the pre-market analysis. We've come up with a narrative of where price wants to go. Now, where can we target? Well, for me, I want to target liquidity and imbalances ideally. So you could do this. For me, if you look at the community tab, my last post, I think it was, I targeted this swing high, right? Which was a nice risk reward. It's about a 1 to 4 risk reward exactly. Now, would I always go for 1 to 4? No. Sometimes would I take profits here? Yes. What I like to do personally, if I'm trading London session, I like to go for 10 handles. So whatever that might be in risk to reward, it's 10 handles. And for me, it makes sense because of the fact that this is all your trendline liquidity, so it should be an abrupt move. And above this swing high here, there's also a 15-minute imbalance. So I'm hoping this is starting to kind of put the pieces of the puzzle together. In this instance, this is just the beginning. Let's see what price action does. Now let's go back just a little bit. When price breaks past this high right here, what would I do with my stop loss? My stop loss is going to be moved to break even. Why? Because we've just swept a point of buy side liquidity. And if my idea is wrong, we could retrace. The market, like looking at the market, we've just been stepping down. So what if the market just wants to keep stepping down? At this point, I move my stop loss to break even. It's a risk-free trade. And this is where my take profit lies, at this level of buy side liquidity. So watching price action, we push through quite abruptly and quite easily. And then look what price does after sweeping that liquidity. We do continue up. But ultimately, it retraces quite a little bit. So the fact that it abruptly gets to this point and then retraces tells you that this here was a really nice strong liquidity. It's a low resistance target because of the trendline liquidity, which is why price trades so aggressively. Using this analysis, we've now paired price and also time. So just as a quick recap, we've merged now price and we've merged now time. We've talked about what led me to taking this entry. We've talked about what led me to target this TP level as my draw on liquidity. And we've talked about the stop loss placement here as well. So it's one of those things when ICT mentions price and time, you've got to have these factors in mind when you're taking trades for yourself. It's really, really, really important. And not only this, for some people, they don't trade this time frame. So let me talk about the next macro and how we can use that to phrase a high probability trade. So again, let me draw this up. That's 150 and this is 210. Now, this is the first macro, by the way. This is the first macro leading into the London Open session. This trade's already played out. We've already imbalanced or rebalanced this fair value gap. You might ask me now, okay, well, why would I enter here? Because I entered a second position here. Why would I enter a second position here if we're already halfway up the move? Here's the important factor. Have a look at this high and this high. Very close together in terms of height. For me, that is a draw on liquidity. At this point, we're also in a macro. So it makes sense for the macro to run to price or expand as we've learned. And it's one of those things where this is something I called out to the Discord. I said, keep your eyes on this inversion fair value gap right here. It's very clear, it's very clean. A bearish gap, a bullish gap outweighs that bearish gap, and we create that inversion fair value gap here. So in this case, what is the time and what is the price? In this case, the time factor is the macro, and the macro here is 150 to 210. Right, that's the time factor. What is the price factor, you might ask? What's the price factor? Well, the price factor is the fact that there are equal highs and the fact that an inversion fair value gap has been created during this macro. So we're merging time, we're also merging price here. So how would you execute a trade from this inversion? It looks something like this. You go for a long position from here. Your stop loss gets placed below this previous swing low. That way your stop loss is below multiple PDRAs. Because again, what do you have here, guys? You have this bullish fair value gap right here, this busy. You have this order block and this inversion fair value gap. So your stop loss always should go above or below 3 PDRAs to make it a strong place to actually, put your stop. If that gets disrespected, then be happy with it. Put your stop loss in a place that makes sense based on the trade that you're looking at. So again, the trade would be phrased something like this, right? Long position from here, stop loss below this previous low, TP at this high, and you get a 1 to 2 risk to reward. So in this case, we're putting price and we're putting time together. And this is personally how I trade. It could be a macro, it could be silver bullet, for example. AM session, New York session, PM session, whatever it might be. Time and price need to merge together. So in summary, talking about these concepts, time can be a factor. It can be macros, it can be a kill zone like silver bullet. And price, it's looking for those imbalances. For me, most of the time it's 15-minute fair value gaps. It's looking for those inversions. It's looking for those bullish gaps. It's looking at how price reacts and respects / disrespects certain PDRAs. Really, really important. Really, really important. So again, I hope you guys have got something from this video. This is one video that I'm going to release. There's another one coming soon. This price action is from Monday, but it's really, really notable. Macros are really important, and you don't have to trade before the London Open session, but you've got to be looking for time and price to be aligned. When those two things are aligned, you phrase the highest probability trades. If you guys have any questions, like always, feel free to leave them in the comments below. And until next time, I'll talk to you guys then. Peace.